Imagine checking your bank account every single month and seeing a deposit roll in, enough to cover your mortgage payment. How much less stressful would life feel if your housing costs were taken care of by passive income? Well, that's exactly what the right monthly dividend investments can do for you. Whether your mortgage is $1,000, $2,000, or more, there's a way to make your investments work like a second paycheck, hitting your account every 30 days. In today's video, I'm breaking down 6 monthly dividend payers that can literally take care of your biggest expense, your mortgage. These are stocks and ETFs designed to deliver steady, reliable cash flow month after month to help you achieve financial freedom. And the best part, they pay you like clockwork, just like a paycheck. Disclaimer: the content provided on Bearish to Bullish is for educational and informational purposes only. Nothing in this video or on this channel constitutes personalized financial, investment, or tax advice. All investing involves risk, including the possible loss of principal. Past performance is not indicative of future results. Before making any financial decisions, you should consult with a qualified financial advisor, accountant, or other professional to discuss your individual circumstances. Why monthly dividends matter? Let me take you back a few years. I was renting a small apartment, dreaming of owning a home, but the idea of a mortgage payment every month felt overwhelming. I'd been investing in dividend stocks, but most paid quarterly. Great for long-term wealth, but not ideal for lining up with monthly bills like a mortgage. That's when I discovered monthly dividend payers, and it was a game changer. Unlike quarterly dividends, which can leave you waiting 3 months for cash, monthly dividends deliver steady, predictable income. It's like getting a paycheck from your investments, perfectly aligned with real-world expenses. This is especially powerful if you're looking to supplement your 9-to-5 income, cover fixed costs like a mortgage or car payment, or build long-term wealth while collecting cash flow now. Think of it like renting out a room in your house, but instead of tenants, your investments are paying the rent. Month after month, no hassle. For retirees, side hustlers, or anyone wanting passive income to ease the burden of big bills, monthly dividends are a dream come true. They provide consistency, which is key when you're planning your budget around a major expense like housing. How much you need to cover a mortgage? Before we jump into the specific investments, let's crunch some numbers to see what it takes to cover a mortgage with dividends. Say your mortgage payment is $1,500 a month. That's $18,000 a year. The amount you need to invest depends on the dividend yield, which is the annual payout divided by the stock or ETF's price. Monthly dividend payers typically offer yields between 5% and 12%, depending on their risk profile. Using a 7% average yield as a middle ground, you'd need about $257,000 invested to generate $18,000 a year. $18,000 divided by 0.07. For a $2,000 monthly mortgage, $24,000 per year, you'd need roughly $343,000 at that same 7% yield. Higher yields, like 10%, lower the amount to around $180,000 for a $1,500 mortgage. This math is your roadmap to financial independence. It shows exactly how much capital you need to make your mortgage disappear with passive income. The 6 monthly dividend payers. Now let's get to the good stuff. The 6 monthly dividend payers that can help you cover that mortgage. I've chosen a mix of stable, high-quality options and higher yield plays to balance income and risk. Here's the lineup, with details on why each one stands out. Realty Income, ticker O, the monthly dividend company. Realty Income is a legend in the REIT world, and for good reason. It's been paying monthly dividends since 1969. This real estate investment trust owns thousands of retail properties, like drugstores and grocery chains, with long-term leases that ensure predictable cash flow. Its current yield is around 5%, which means a $100,000 investment generates about $5,000 a year, or $416 a month. Realty Income's nickname, the monthly dividend company, says it all. It's a rock-solid anchor for any income portfolio, perfect for investors who want stability and consistency. STAG Industrial, ticker STAG. STAG Industrial is another REIT, but it focuses on industrial real estate like warehouses and logistics centers. With the e-commerce boom, think Amazon, FedEx, and Walmart needing massive distribution hubs, STAG is riding a major growth wave. It pays monthly dividends with a yield of about 4.5% to 5%. For example, $50,000 invested in STAG could generate $2,250 to $2,500 a year, or roughly $187 to $208 monthly. Its focus on industrial properties gives it a strong growth outlook, as demand for warehousing continues to surge. SL Green Realty, ticker SLG. SL Green is a higher risk, higher reward REIT, focused on office properties, primarily in New York City. Its yield swings between 7% and 9%, depending on market conditions, making it a juicy option for income seekers willing to tolerate volatility. A $50,000 investment at an 8% yield generates $4,000 a year, or $333 a month, enough to chip away at a mortgage. SL Green's urban focus means it's sensitive to economic cycles, but for those comfortable with risk, it's a powerful income generator. EPR Properties, ticker EPR. EPR Properties adds a fun twist to REITs, investing in experiential real estate like movie theaters, ski resorts, and amusement parks. It pays monthly dividends with a yield of 7% to 8%. For instance, $75,000 invested at 7.5% yields $5,625 annually, or about $469 a month, nearly a third of a $1,500 mortgage. EPR's unique portfolio diversifies your income stream away from traditional properties, and its focus on entertainment taps into consumer spending trends. Global X SuperDividend ETF, ticker SDIV. If picking individual stocks isn't your thing, consider an ETF like Global X SuperDividend. This fund holds over 100 high-dividend companies worldwide, from REITs to utilities, and pays monthly dividends with a yield of 10% to 12%. A $100,000 investment at 11% generates $11,000 a year, or $916 a month, more than $1,500 mortgage. The trade-off? Higher volatility due to its global exposure and riskier holdings, but the built-in diversification makes it a great option for hands-off investors. Prospect Capital, ticker PSEC, BDC. Prospect Capital is a business development company, BDC, which acts like a lender to private middle-market businesses. It's known for double-digit yields, often 9% to 12%. A $50,000 investment at 10% yields $5,000 a year, or $416 monthly, almost a third of a $1,500 mortgage from one holding. PSEC's high yield comes with higher risk, as its investments in smaller firms can be sensitive to economic downturns. Think of it like lending money to businesses and collecting interest. Lucrative, but not without challenges. Building a dividend mortgage portfolio. So how do you turn these 6 investments into a mortgage-paying machine? The key is diversification and balance. Combine safer options like Realty Income and STAG for stability with higher yield plays like PSEC and SDIV for bigger payouts. Here's a sample allocation for a $257,000 portfolio targeting a $1,500 monthly mortgage, $18,000 per year. 40%, $102,800 in Realty Income and STAG, split evenly. These yield approximately 5%, generating $5,140 per year, $428 per month for rock-solid cash flow. 30%, $77,100 in Global X SuperDividend ETF. At 11%, this adds $8,481 per year, $707 per month with global diversification. 30%, $77,100 in EPR Properties and Prospect Capital, split evenly. At approximately 8% and 10%, these yield $6,930 per year, $577 per month for higher income. This blend delivers roughly $18,551 per year, or $1,546 per month, covering a $1,500 mortgage with a little extra. Adjust percentages based on your risk tolerance. Lean heavier on Realty Income for safety, or PSEC for income. Reinvesting dividends early on can compound your returns, growing your portfolio faster. Risks and things to watch. No investment is perfect, and monthly dividends come with risks. First, yields aren't guaranteed. Companies can cut dividends if earnings falter, especially riskier ones like PSEC or SL Green. Second, market downturns can hit share prices and payouts, particularly for REITs tied to real estate cycles. Third, inflation can erode your dividends' purchasing power, so monitor real yields. Finally, rising interest rates can pressure REITs and bond-heavy ETFs like PDI as borrowing costs climb. Always check a company's payout ratio, earnings paid as dividends, and financial health to ensure sustainability. So here's the key takeaway. Monthly dividend stocks and ETFs can absolutely provide enough cash flow to pay a major bill like your mortgage. But it's not a get-rich-quick scheme. You need consistency, patience, and diversification to make it work. Start small, automate your investments, and watch that passive income grow. If you enjoyed this breakdown, hit that like button to support the channel. Comment below which one of these 6 monthly dividends you'd consider adding to your portfolio, or if you're already building your own mortgage portfolio. Are you Team Realty Income for stability or PSEC for those juicy yields? Let me know. Don't forget to subscribe for more investing strategies that build real passive income, and check out my other videos on dividends, tech, and wealth building. Thanks for watching, and remember, make your money work just as hard as you do.